This podcast is for professional investors only.
If you think about what's happening at the investment banks, they're saying, well, actually, we're going to have to raise margins for people that are using leverage, like hedge funds, and say, actually, we need to have more collateral in place against your positions. That means the hedge funds are having to sell. So you've seen leverage ratios come down in hedge funds. So the indiscriminate selling, firstly, you sell what you could, and now people are beginning to sell whatever they can.
Welcome to a new episode of the Robeco podcast.
You're listening to Robeco Market Flash. Markets have plummeted since the so-called Liberation Day, the day that President Trump announced a broad swathe of tariff hikes imposed on the US's allies and foes alike. I'm Erica van der Merwe, joined now from London by Colin Graham, who's co-head of Investment Solutions. Welcome, Colin.
Good morning, Erica.
A lot of sharp market movements over the past few trading days. I know you cycled to work this morning in the city of London. What was the vibe around you on this beautiful sunny day? It was
a very pleasant ride, and I have to say it was more pleasant than watching the Bloomberg and what's going on in markets.
How significant would you say this development is, this announcement from the US administration, and how should investors frame it?
Erica, if things stay as they are and there's no U-turns from this perspective, then we see this as being a structural break in the way investors should look at the markets. And what does a structural break entail? That entails that basically all the models that you've been using over the last 4 or 5 years can't predict the future or can't give you an idea of the future. So if I think about how we look at the markets, we think about in scenarios. So if we go back to our 1-year outlook, you'll see that we had a bear case scenario in there, which had a reasonably low probability. But where we are today, that scenario is actually priced into markets. So in a normal time, this would be a time that we'd be looking to add risk to portfolios. We'd say, okay, the central case is still the case because you can see that the hard data in the US and around the world is fine. So nothing's really changed. So therefore, that gives us an opportunity to add risk. However, because of Liberation Day, you can see that the trading systems around the world have to change. So is this a new world order? We'll have to wait and see. But it means that we can't be confident to add risk at this point, and therefore we have to wait and see how things pan out and, cut our risk, take our risk back to neutral in portfolios, add a bit of hedging and see how things work out.
So a clear point there. You're saying, the whole system is changing, so we can no longer apply the thinking we've had over the last, 2 years of, buy the dip, all is still well. It's a completely different frame of reference. But you also made the point is we just don't know. There might be a U-turn. We've seen the US administration, the new administration making U-turns, using announcements as a point of leverage. And so that makes it doubly difficult for markets not knowing which scenario to price in.
Absolutely. And if you think about a business owner, CEO, do they go all in and say we have to move production to the US because that could change tomorrow and maybe in 3.5 years it will change as well. So, it's very difficult for CEOs, and that's why confidence in the survey data is so poor because people just don't know. But the hard data is fine. The issue is that as we get into later in the year, the earnings will get hit by tariffs. And therefore, that's what's really worrying us to say, okay, you can see a 20% fall in earnings and a 20% fall in markets, but you haven't actually got cheaper valuations in equity markets. So that is the sort of the spiral that markets are trying to price in and think about in the future.
Let's look at the market reaction for now. So at first it was, I think to a large extent, the tech sector being hit. Now it seems to be a more broad-based decline, banks because of consumer sentiment, and then other sectors because of fear of a growing likelihood of a recession.
Absolutely. You saw that last week all sectors in equity markets in Europe and the US were down. So you're reaching a point where you are seeing indiscriminate selling. If you think about what's happening at the investment banks, they're saying, well, actually, we're going to have to raise margins for people that are using leverage, like hedge funds, and say, actually, we need to have more collateral in place against your positions. That means that hedge funds are having to sell. So you've seen leverage ratios come down in hedge funds. So the indiscriminate selling, firstly, you sell what you could, and now people are beginning to sell whatever they can.
So if they're selling whatever they can, are they holding cash? Are they finding safety in bonds?
I think you're seeing that in bonds. You've seen a significant fall in the long bond yields across the world. I think Japan's gone from 140 to just over 1 in the space of a couple of days. Yields, 10-year yields. So you are seeing that flight to safety. So from a multi-asset perspective, that's great because you're starting to see diversification come into your portfolio. So you can hold bonds and equities and you get that the last free lunch of investing where you get diversification. So you are seeing that, but the fall in bond yields isn't doing nothing to offset the magnitude of falls in equity markets from our perspective. So correlations between equities and bonds are falling, which is great. But you've got to think that the wisdom at the moment is that tariffs are inflationary. So there will become a point where investors think, well, actually, longer bonds have inflation risk in them. So should the US 10-year be below 4? And that's a question that will come in the future.
What about currencies? Is there a currency where you'd be comfortable holding your cash?
So US dollar cash, I think, is key, but you have to hedge it back to your base currency. So the euro, we're neutral euros across our portfolios, but one currency that we see as a safe haven in this is the yen. So we've been adding to a long yen position, mainly against the euro, but we've started adding against the dollar as well because we see the event risk offsets any carry loss we're going to get because interest rates in the US are way above that in Japan.
What about commodities and commodity exposed stocks? Would this simply be a reflection of concerns about a recession? So these are declining. Are there exceptions?
Not really. So gold has been the sort of standout in the Q1, the best performing asset, major asset that you could hold in a multi-asset portfolio. Even that's coming under pressure. And that's more to do with the fact that the people have bought gold and want to sell their profits. So you will see profit taking in gold, but that would be somewhere where investors can hide, but there is lots of speculative money in gold at the moment, and that has to come out first before you get back to the fundamentals in gold.
So in short, how are you positioning your multi-asset portfolios right now, and to what extent are you differing from the market?
I'm not sure we're differing from the market, but over the first quarter we've been long, we've been underweight, we've been neutral. So at the moment we're neutral equities and we're letting that drift down. So we're not inclined to buy equities right now. In fact, we're discussing going shorter equities in the portfolio in order to sort of protect capital for clients. We keep our high yield and IG hedging on. So we've hedged our underlying bonds in IG and high yield. So from that perspective, we're not really seeing any selling pressure of high yield or investment grade bonds. However, if this does continue, then you could see more pressure coming there and you'll see the cost of protection for high yield and investment grade go up. So we would benefit from that there. But again, it's nothing to offset what's going on in equity markets. And in terms of gold positions, then we've been actually selling our gold over the last couple of weeks, as we thought that you saw it being overbought and all the technicals were telling you that this has gone too far in the short term. It was nothing to do with tariffs or anything like that. Right. It was just looking at the markets and saying we should be taking profits here.
Yeah. Colin, final words of wisdom. Through your career, you've seen many instances of sell-offs, painful ones as well. How would you rate this, and what suggestion would you have for investors who might be concerned?
Well, on this, I think you have to go back to investors that are much older than I am, seen much more cycles. So people like Warren Buffett and a few others, where they say these are the times that you want to be buying when there's concern in the market and everybody's going the opposite way. So, however, with valuation support for equities isn't there. So we're probably going to see some more pain before you start to see buyers come back into the market. But the opportunity arrives, and diversification is key. But we're always looking for the opportunities to generate investment returns for our clients.
Colin, thank you so much for your comments. Have a good day.
Yes, thank you, Erica, and thanks for listening.
Stay tuned for more Market Flash updates from Robeco.
Thanks for joining this Robeco podcast. Please tune in next time as well. Important information. This publication is intended for professional investors. The podcast was brought to you by Robeco and in the US by Robeco Institutional Asset Management US Inc., a Delaware corporation, as well as an investment advisor registered with the US Securities and Exchange Commission. Robeco Institutional Asset Management US is a wholly owned subsidiary of Oryx Corporation Europe NV, a Dutch investment management firm located in Rotterdam, the Netherlands. Robeco Institutional Asset Management BV has a license as manager of UCITS and AIFs for the Netherlands Authority for the Financial Markets in Amsterdam.